what are the macro variables that affect credit risk and perception of credit risk?
That's an excellent question, Ankita, because macro variables do play a very important role when it comes to credit risk as well as perception. So let's take it into the two bits that you have referred to. First is in terms of what happens when the economy is not doing well, right? When the economy is doing well, everybody is happy, credits are getting paid, and things are pretty okay. Let's say inflation is high and the central banks have to raise rates. Slowly, that leads to economic slowdown. And I'm telling the economists this, which is not a good thing, but you know that. And the second order effect of it is that the marginal borrower always is getting squeezed out. And what is also happening is that you've heard of zombie companies internationally, right? So the zombie companies are getting flushed out as they're not getting funds anymore. That on an aggregate level leads to defaults. So that is at a very macro level, and we'll come hopefully later to what good companies do. Then you have the credit perception issue, or what we call credit spreads. What is credit spread? It's the differential in yield for a certain credit from a risk-free asset, which is usually a GSEC of a similar tenor. What happens when there is tightness in the market is that credit spreads start to widen. Ironically, it's only when the credit spreads are at the narrowest that investors are looking for yield and they're piling on risk. In fact, like we are fond of saying that if you want to buy a shirt, you buy it on sale, but if you want to buy any risk asset, you buy it at the most expensive times, right? So credit spreads tend to widen, and that's what happens when the macroeconomic slowdown happens. But there's also third associated risk, which is not macroeconomic per se, but it has to do with the risk of liquidity. And we all know what happened for one of the mutual funds when they could not meet redemptions. It was not to do with underlying credit, but as much as the liquidity of the underlying credit, which gets hampered during periods of slowdown, or when people sense economic vulnerability. So these are broadly the three things that happens. On an aggregate level, the credit deteriorates. So you have to pick the right companies. Credit spreads usually start to widen, and it has its own demand supply dynamics, but generally they start to widen. And liquidity in the market comes down. So those are the three things that the investors have to remember.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.